If you have ever felt like the market is targeting your stop loss before moving in your direction, this is not random. It is liquidity. And in this video, you are going to understand exactly how liquidity works, how it forms on the chart, and how professional traders use it as part of their trading strategy. We are going to break down a complete top-down analysis, combining market structure, price action, and liquidity, so you can stop reacting to the market and start anticipating it with precision. By the end of this video, you will see price differently, not as random movement, but as a flow from one liquidity pool to another. Exactly how the best traders approach the market. So, if this type of content is valuable to you, remember to like the video, subscribe to the channel, and enable notifications so you don't miss the upcoming lessons. And feel free to share in the comments which topics you would like us to explore in future videos. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to continue producing this kind of educational content. So, let's begin by breaking down one of the most important concepts in trading. What is liquidity, and how does it actually behave in the market? Because whether you are using a price action trading strategy, a supply and demand approach, or a more advanced liquidity trading strategy, everything starts with understanding how liquidity works. To answer that, we need to approach it from a practical perspective, focusing on how smart money interacts with liquidity in real market conditions and how this drives price movement. Now, consider how large financial institutions, often referred to as smart money, operate when they want to build a position in a currency pair. To execute that position, they need sufficient liquidity, meaning a large number of participants willing to take the opposite side. Without available sellers, buy orders cannot be filled. This is why the market often moves in a way that triggers existing stop-loss orders, providing the liquidity needed for these larger players to enter or exit positions. From a retail perspective, this can feel like manipulation as price creates moves that appear clear, only to reverse after taking liquidity. This creates a common trap. Many traders believe they are positioned correctly, but the market moves into their stop losses first, takes that liquidity, and only then continues in the expected direction. For a trader aiming for consistency, identifying liquidity on the chart is not optional, it is essential. These zones, where orders are concentrated, reveal how the market is likely to behave and help you avoid unnecessary losses. Liquidity can be classified into two types: static liquidity and dynamic liquidity. Let us break both down in a practical way. Dynamic liquidity relates to the forces that drive price movement. In simple terms, it reflects how price flows through structure. To visualize this, think of a typical market swing with a defined high and a low. These highs and lows represent external liquidity. External liquidity refers to the liquidity resting beyond key swing points. On the other hand, the fair value gaps within that range represent internal liquidity. Price is constantly moving between these two types. In practice, the market cycles between internal and external liquidity, moving from one to the other in a continuous flow. Looking at this schematic figure, we can see a rally wave moving upward, sweeping the external liquidity above the previous high. After that, price shifts toward internal liquidity, represented by a fair value gap, to rebalance inefficiencies left behind. From there, price transitions again toward external liquidity. In essence, the market moves from internal to external liquidity, then back again. Once external liquidity is taken, price often seeks balance by returning to internal liquidity, filling the most recent gaps. Now, shifting focus, let us examine static liquidity. Static liquidity refers to specific areas on the chart where a large pool of orders is resting, such as stop losses and pending buy or sell orders. Every time a stop loss is triggered, that liquidity is absorbed by the market. This is why recognizing a liquidity sweep before price reaches a key level is so important. It provides confirmation that your area of interest, whether supply or demand, has a higher probability of holding. Liquidity sweeps are not random. They are part of how the market builds momentum. If price does not take liquidity before reaching a level, it will often use that level itself as liquidity. This is why understanding where liquidity is located is critical for timing and execution. Static liquidity can be identified in several recurring areas on the chart, such as below equal lows and above equal highs, above swing highs and below swing lows, around trend lines and channels, and within or around order blocks. It is also present around support and resistance levels, Fibonacci retracement zones, and near the body and wicks of daily candles. When you consistently recognize these zones, you begin to understand how strongly they influence price direction. Ignoring them often leads to unnecessary losses. Some of these areas attract more attention than others, especially those widely recognized by traders, which leads to a concentration of stop losses and pending orders, increasing the probability that price will move toward them to capture liquidity. Understanding liquidity gives us clarity about where price is likely to move. But clarity alone is not enough. To trade consistently, you need to see how this actually plays out on the chart. Because in the end, the real edge comes from recognizing liquidity in real time, not after the move has already happened. That is exactly what we're going to do next. Before we begin the chart breakdown, I want to explain how I read the market and organize information on my charts. I always use a top-down approach, starting from higher time frames to define direction and context, and then working down to lower time frames for execution. This means we are always working with at least 3 time frames. In this case, we will use the weekly, the daily, and the 60-minute chart to build our analysis and execute with precision. And this approach is not limited to these specific time frames. The same logic can be applied to any combination, such as the 1-hour, 15-minute, and 1-minute charts. What matters is not the exact time frame, but the structure of the analysis, always building from higher time frames into lower ones. Because the higher the time frame, the more reliable the information becomes, and the stronger the overall framework of the trade. In this Euro-Dollar Masterclass, we will first analyze the weekly structure to understand the dominant direction of the market. Then we will move into the daily chart to identify the key areas that are likely to shape the next reaction. After that, we will drill down to the 60-minute chart to time our execution with precision, always aligned with liquidity and structural flow. Inside this study, we will also build 2 practical entry models. The first is a daily-based entry that reacts to the 50% level of the fair value gap and focuses on favorable risk-to-reward conditions. The second is a 60-minute entry that waits for a confirmed change of character before positioning, providing a tactical option for intraday alignment. By the end of this video, you will have a complete multi-time frame blueprint and 2 entry methods you can apply with confidence. Now we're going to start looking at the charts, and the pair we're analyzing in this study is the euro-dollar. Before we begin, keep in mind that every number I mention, such as weekly higher high number 4 or weekly higher low number 3, is simply a reference point to help you visualize the chart more easily. These numbers do not carry any meaning beyond guiding you through the structure shown on the screen. As we move into the weekly chart, we start to see the broader structure that shapes everything happening on the lower time frames. The story begins at the weekly low number 1. The moment when the market finally stops falling and creates the first potential shift in direction. From there, price expands upward and delivers the weekly change of character number 1, confirming that buyers have stepped in and taken control by breaking the previous weekly structure. After that, the market continues pushing higher into the weekly high number 2, establishing the first major peak of this new bullish cycle. Next, the market retraces and forms the weekly higher low number 3. A clean pullback that keeps the weekly trend intact and shows that demand is still active. From this point, price begins a new bullish leg that drives the market into the weekly higher high number 4, leaving behind the weekly break of structure number 2 and reinforcing the continuation of the trend. If you want to strengthen your ability to read this type of market structure, I recommend watching the video from our Smart Money course called the Ultimate Market Structure Masterclass, available in the description. At the top of this push, we have the weekly higher high number 4, together with the weekly possible break of structure number 4, which signals a possible structural shift, but still requires confirmation. The chart also highlights the weekly order block number 3, the zone that originated the main bullish displacement, and remains an important reference point for deeper retracements. In this specific movement, which is the leg from the weekly higher low, number 3, up to the weekly higher high, number 4, price has already retraced beyond the 38.2% Fibonacci level, which, according to our ComLucro rules, is enough to classify the correction as valid. Price is now approaching the 50% retracement of this leg, moving closer to the discount zone where deeper reactions often occur, although it is still positioned above the weekly order block number 3. And this is where one key concept becomes essential. Because when we say that price is moving into a discount zone, we're not just referring to a level, but to where price is positioned within the entire range. Let's clarify that quickly. What is discount and premium in the ICT method? And why does it matter for how price is analyzed and traded within a range? When analyzing price within the ICT framework, one important concept quickly becomes clear. Price does not offer the same opportunity at all levels of a range, and context always matters. This observation naturally leads us to the idea of discount and premium as a way to frame price location more effectively. To understand how these zones work in practice, we must first understand the idea of a range. A range is simply the space between a swing low and a swing high, or between a swing high and a swing low. This range defines the boundaries within which price is currently moving. Let us take the example of a range that forms from a swing low to a swing high. To define the premium and discount zones, we divide this range into 2 equal parts. The upper half of the range is always called the premium zone, while the lower half of the range is always called the discount zone. So when using the Fibonacci retracement to define discount and premium zones, it is essential to draw it in the correct direction. In a bullish scenario, where the range is measured from a swing low to a swing high, the Fibonacci should be drawn with the 0 level placed at the swing high and the 1 level placed at the swing low. When we look for long trade opportunities, we want price to trade in the discount zone, assuming there are other elements supporting the trade idea. The deeper price trades into the discount zone, the greater the potential risk-reward ratio. This is especially true when the stop loss is placed below the swing low and the target is set near the swing high. For downward price movements, we measure the range from a swing high to a swing low. So in bearish scenarios, the Fibonacci retracement should be drawn in the opposite direction. The 0 level is placed at the swing low, and the 1 level is placed at the swing high. In this case, we want to look for short trade opportunities in the premium zone. The higher price trades into the premium zone, the better the potential risk-reward ratio, assuming the stop loss is placed above the swing high and the target is set near the swing low. This concept of discount and premium is very simple, but it is essential to keep it in mind at all times when analyzing price. It provides a clear framework for evaluating where price is located within a range and helps define where higher probability trade opportunities are more likely to form, especially when combined with proper structure and confirmation. So now this gives us a clear understanding of location. We are not just looking at levels. We are evaluating where price is trading within the range and whether it is offering favorable conditions for a trade. With that in mind, the most important movement for our analysis is exactly this leg between the weekly higher low number 3 and the weekly higher high number 4. Since this is where the current retracement, the Fibonacci levels, and the potential structural shift are all developing. Now on the daily chart, we begin our analysis at the daily higher low number 1, the point where the market confirms short-term strength and begins building the internal structure that supports the larger weekly trend. From this higher low, the market expands upward and delivers the daily break of structure number 2, which shows that buyers gained momentum inside the daily flow and pushed price above the previous short-term high. After this expansion, price continues climbing until it reaches the daily higher high number 3. This level becomes a key reference for the bullish leg that follows. Once price reacts from this high, the market begins to pull back, and during this movement, we mark the daily failed change of character number 2. This shift is considered failed because after the attempt to break below the previous structure, price does not produce a break of structure to confirm the reversal. For a change of character to be valid in our ComLucro rules, it must be followed by a break of structure. Since that confirmation never appears, the bearish attempt is invalid and the bullish structure remains intact. As the pullback continues, the market finds support at the daily higher low number 4, which forms the base for another upward movement. From here, price pushes again and reaches the daily higher high number 5. This daily higher high number 5 is the same point as the weekly higher high number 4, meaning both time frames align at this structural extreme. At this same level, we also find the weekly possible break of structure number 4 and the daily possible break of structure number 5, both signaling that a potential structural shift may occur if price confirms with continuation. During this phase, we also highlight the daily fair value gap number 4, an inefficiency left behind during the bullish displacement. If you want help identifying fair value gaps correctly on your own charts, I suggest watching the video FVG Explained, How the Best Traders Spot Precise Entries, which is linked in the description. Beneath this gap, we also mark the daily change of character number 4, the level where a confirmed shift in daily momentum would take place if price breaks and closes below it. Finally, we approach the daily order block number 4, the key daily demand zone that sits above the larger weekly order block number 3. This alignment between daily and weekly demand strengthens the narrative because price is pulling back into an area where the higher time frame already suggests discount conditions. As price approaches this zone, the daily structure prepares for the next decisive reaction, setting the stage for continuation or reversal inside the weekly context. At this point, we can clearly see how structure and liquidity align on the chart. But to fully understand why price reacts so precisely at these levels, we need to look deeper into how liquidity is actually created and used, because what you are seeing here is not random. These reactions come from very specific areas where orders are concentrated. So what exactly is buy-side and sell-side liquidity, and where does it form in the market? Retail traders typically look to buy when price approaches a lower boundary or a perceived support area, placing their stop losses just below it. This creates a concentration of orders beneath that zone, made up of the stop losses of buyers, ready to be triggered. In addition, it often includes sell stop orders from traders expecting a breakdown, believing price will continue lower once that level is taken. On the opposite side, when price approaches an upper boundary or a perceived resistance area, many retail traders look to sell, placing their stop losses above it. At the same time, buy stop orders begin to accumulate from traders expecting a breakout. This creates another concentration of orders above the structure, with multiple types of positions clustered in the same area. Therefore, buy-side and sell-side liquidity do not exist only at traditional support and resistance levels. They form wherever there is a concentration of orders in the market. Buy-side liquidity refers to areas where buy orders are clustered, often above highs or key reference points, while sell-side liquidity refers to areas where sell orders are clustered, typically below lows or areas where traders expect breakdowns. Next, we examine how the market responds when it approaches these zones. Suppose price is moving toward a visible area where many orders are likely to be resting, and traders begin positioning themselves based on that expectation. If price pushes beyond that level, it triggers those orders, creating a surge in activity as positions are forced to execute. This reaction generates momentum and often leads to a sharp movement as liquidity is being taken from that area. These behaviors can appear in any type of market structure. The key idea is not the specific pattern, but the presence of clustered orders. Understanding where these concentrations form allows traders to better interpret price movement and anticipate how the market may react when those areas are reached. In simple terms, the market moves from one area of liquidity to another, driven by orders being triggered and absorbed. By understanding buy-side and sell-side liquidity, you begin to see the market as an interaction between buyers and sellers. So now, when you look back at the chart, these levels are not just structure. They are liquidity targets. And this is the key shift. The market does not move randomly. It moves from one pool of liquidity to another, taking orders before delivering the real move. With that in mind, now we move to the 60-minute chart. And at this point, we will look for two different types of entries that align with both the daily narrative and the intraday structure. The first type of entry comes directly from the daily context. When price taps the 50% level of the daily fair value gap, we prepare a buy order targeting the order block on the 60-minute chart that created the last change of character to the downside. With a stop loss placed just below the daily fair value gap, the risk to reward becomes 1 to 4.80. If we choose a more conservative stop, placing it below the daily order block, the risk becomes higher and the reward becomes smaller, reducing the overall efficiency of the setup. The second type of entry is more aligned with the internal structure of the 60-minute time frame. Since price has already tapped the daily fair value gap, we will now wait for a confirmed change of character to the upside on the 60-minute chart as a condition to open a long position. Once this shift is validated, we enter the trade, placing the stop loss below the swing low that forms the change of character. The target, once again, is the 60-minute order block that caused the last bearish change of character, creating a risk to reward of 1 to 1.9 and offering a tactical intraday entry that respects the structure of this time frame. And as we finish this study, it's important to note that every entry model we outlined here reached its target with precision. Both the daily-based entry and the intraday 60-minute entry delivered clean reactions and completed their objectives, showing how structure, alignment, and clear execution rules can lead to consistent and profitable outcomes. From this point forward, every chart you open should tell you the same story. Where is the liquidity, and where is price likely to go next? But knowing where price is likely to move is only part of the equation. The next step is understanding when the best opportunities actually appear during the trading day, and how professional traders use timing to execute with precision. That is exactly what we break down in the next video. Now, before we go deeper, let's start by understanding what kill zones actually are. Kill zones are simply specific times during the day when a large amount of liquidity enters the market, creating strong trading opportunities. In this video, we will focus specifically on the London kill zone. This refers to a defined time window during the London session when the market tends to produce significant moves. But first, let's see how to identify the London kill zone directly on your chart. To do this, open your chart on TradingView and go to the Indicators tab. From there, search for Market Sessions and select the indicator created by Leviathan. This tool displays all trading sessions, so we need to adjust it slightly. In the settings, uncheck Tokyo and New York, then change the London session close to 1300. After that, the London kill zone will be clearly marked on your chart. So, trader, if this video helped you gain more clarity, make sure to like the video, subscribe to the channel, and turn on notifications so you do not miss the next lessons. And let me know in the comments which topics you would like us to explore in future videos. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro trader community right here on YouTube. It's a simple way to support the channel and a smart investment in your growth as a trader. You will also find links to our trusted partners in the description below. Using those links helps support the channel and allows us to keep producing this kind of educational content. Please also remember that the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you will find complete courses designed as a true trading masterclass. We teach liquidity, market structure, higher time frame analysis, and supply and demand, always focused on understanding price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency, because trading is not just about charts. It is about mindset, discipline, and execution over time. Our main courses include Smart Money Concepts, ICT, Technical Analysis, Trading Psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you better understand how markets really behave. Thanks for watching, and I will see you in the next video.